Let's dive right in. Today, we're unpacking a quiet, almost invisible force operating in the financial world. We're talking about a phenomenon that's created more wealth for everyday people than any clever stock tip, any hot new asset, or frankly, any complicated trading strategy ever invented. The best part? It doesn't require you to be a genius, it doesn't require luck, and it doesn't even require a massive pile of cash to get started. What it does require, though, is time. That and just a little bit of patience. Great minds have revered this concept for generations. Albert Einstein reportedly called it the most powerful force in the universe, and legendary investor Warren Buffett has constantly cited it as the absolute foundation of literally everything he's ever built. Yet somehow, most people completely fail to harness it. We all kind of nod along when it's mentioned at dinner parties, right? But we don't truly understand how it works or what it actually feels like in practice. Well, by the end of this explainer, you're going to see this concept so clearly that it will permanently change the way you approach your financial decisions. Okay, let's look at a real-world example. Picture two people, Clara and James. Clara is 22 years old, just starting out in her career. She decides to quietly put aside just $200 every single month into an investment account. She doesn't stress over it, she just treats it like a totally non-negotiable bill paid to her future self. Meanwhile, her friend James is doing what honestly a lot of us do in our 20s. He's living it up, traveling, telling himself he'll invest later when he feels more ready. Fast forward to age 35, and James finally starts. Ambitious to make up for lost time, he invests $500 a month, which is more than double what Clara is putting away. Now, what's really interesting about this is the final tally. At age 65, assuming an average historical return of about 8%, Clara retires with roughly $1.1 million. She actually ends up with about $400,000 more than James. Just let that sink in for a second. James personally invested way more of his own hard-earned money out of pocket over his lifetime, yet Clara ended up vastly wealthier. So, how on earth is that mathematically possible? Section 1. The magic of the snowball. How time beats money. To answer that, we really need to understand the actual mechanics behind Clara's success. Think of Warren Buffett's famous analogy. Picture a single snowball at the very top of a massive hill covered in fresh snow. As it rolls, it picks up snow, right? Because it's now slightly larger, its very next rotation picks up even more snow, and so on. It grows faster the further it rolls down. Let's walk through the math with just a single $1 bill, growing at 10% a year. After 1 year, you have $1.10. Not exactly life-changing stuff. Even by year 10, it's grown to just $2.59. Honestly, this beginning stage feels incredibly slow and pretty unimpressive. But here's where you have to resist the urge to look away, because the magic is literally just getting started. This brilliantly illustrates the real secret of the snowball. Look at this breakdown. Out of 50 years, the first 30 years only produced $17 of growth. But those last 20 years, they produced $100. The vast majority of the explosive growth happened in the final act. Compound interest does not reward speed, and it absolutely does not care how excited you are on day one. It rewards duration. The longer your hill, the more spectacular the final result. Section 2. The villains. Debt and hidden inflation. But looking at the math, there's a serious trap here. Compounding doesn't judge. It simply multiplies. If you're investing, it builds your wealth upward. But imagine carrying a $1,000 credit card balance at a 20% interest rate and only paying the bare minimum. This creates a really painful mirror effect. Your debt compounds. Interest is added to your balance, and then, get this, you are charged interest on that interest. It relentlessly consumes your wealth upward, trapping you for over a decade and often costing you double what you originally borrowed. High-interest debt and long-term investing simply cannot comfortably coexist. And then there's the invisible villain, inflation. This is the gradual increase in prices over time. Think about a standard cup of coffee that cost $1 in 1990. Today, that same cup might cost you $4 or $5. If you keep your money parked in a mattress or a zero-interest checking account, it's silently eroding. Now, you aren't technically losing actual dollar bills, but you are losing purchasing power, the actual ability to buy things in the real world. That is the hidden cost of delay. Choosing not to invest isn't a neutral decision. It's a decision to slowly lose ground. Section 3. Buffett's Coca-Cola machine. Let's move from theory to reality. Back in 1988, Warren Buffett started buying Coca-Cola stock. At the time, a lot of critics thought it was totally boring. It wasn't some fast-growing tech startup, it just sold flavored syrup. But Buffett saw a compounding machine. Coca-Cola had this massive global presence and the pricing power to raise costs modestly year after year without losing its loyal customers. This meant steady, reliable earnings growth. Plus, Coca-Cola paid dividends. Think of a dividend like collecting monthly rent from a tenant in an apartment you own. By taking those regular dividend payments and reinvesting them right back in to buy even more shares of Coca-Cola, Buffett rapidly accelerated his snowball into a self-reinforcing engine of immense wealth.
But here is the catch, and it's a big one. It requires incredible discipline. Take a look at this timeline. Buffett held onto his investment through the massive dot-com bust, the terrifying 2008 financial crisis where markets basically fell in half, and the sudden 2020 pandemic crash. During every single one of these crises, Coca-Cola's stock price plummeted. But did Buffett panic and sell? No way. He focused on the business's true enduring value, knowing people would keep right on drinking Coke. He just ignored the temporary fear in the market, allowing the mathematical process of compounding to continue entirely uninterrupted.
Okay, let's dive into this next part, Section 4, the index fund strategy. Now, you might be thinking, hey, I don't know how to analyze businesses like Warren Buffett does. And luckily, you really don't have to. Notice how an S&P 500 index fund holds tiny slices of 500 of America's absolute largest companies in a single, perfectly simple investment. You get a piece of Apple, Microsoft, Disney, Amazon, and literally hundreds more. You don't have to try and pick the winners, because you already own the entire basket. Over the long history of the American stock market, the S&P 500 has averaged roughly a 9% return per year. Look at the staggering result of that average over time. If you invest a simple $300 a month starting at age 25 and just hold it until age 65, you personally contribute $144,000. But the compounding growth? That adds up to over $1.2 million. Your total is roughly $1.4 million. To put that into perspective, compounding essentially creates 9 times the wealth you're actually put in. So pull this off. You do not need a high IQ. What you need is an emotion-free habit. Step 1, set a fixed amount you can actually afford. Step 2, invest it every single month without exception. And step 3, which is absolutely crucial, ignore the financial news. Seriously, just turn it off. When the market drops and everyone is panicking, your fixed monthly investment is actually just buying more shares at lower, discounted prices. It's consistency, not cleverness, that separates people who build wealth from those who don't. Section 5, a tale of 2 farmers. To bring all these numbers together, imagine 2 farmers given identical plots of land. Farmer 1 plants his seeds immediately. When he gets his very first harvest, he doesn't just eat all the apples. He takes a portion of them and replants them to grow new trees. Over 40 years, his constant reinvestment creates an unbeatable, massive orchard. Now, Farmer 2 is also smart, but he decides to wait. He reads all the right books, he studies the soil, and he waits a whole decade for the quote-unquote perfect weather conditions before planting. While his orchard eventually grows, that missing decade of compounding can never, ever be recovered. No amount of extra hard work in his later years can close the gap created by that lost time. The real psychological trap of delaying your investments is that it doesn't hurt today. When James decided to wait at age 25, his life felt perfectly fine. The pain only shows up decades later when the math is finally revealed. But as we've seen, time is without a doubt your most valued asset, and the hill is still long enough for you. So which farmer will you choose to be today? The perfect moment to start your snowball isn't tomorrow, it's right now.